Howard Marks often says, you can't do the same thing as everyone else and expect to outperform. This simple yet profound truth is at the heart of what he calls second-level thinking, the ability to look beyond the obvious, to question assumptions, and to think differently about markets, value, and risk. In a world dominated by noise, herd mentality, and emotional reactions, Marks' philosophy invites us to step back and ask, what if everyone is wrong? At first glance, investing seems like a numbers game: ratios, growth rates, margins. But Marks argues it's a thinking game. The first-level thinker sees only surface data: this is a good company, it will go up. The second-level thinker asks, everyone thinks it's a good company, but is that already priced in? What could go wrong? What does the market not see? This mindset isn't just about intelligence, it's about perspective. Second-level thinking is rare because it demands humility, patience, and a willingness to be misunderstood. It's about detaching yourself from the crowd and forming an independent judgment when others are swept by emotion. Imagine a room full of investors all reading the same reports, following the same headlines, and reacting the same way. The first-level thinker buys because the news is good, the second-level thinker sells because everyone else buying has already pushed prices too high. The essence of Marks' approach is psychological as much as analytical. He believes that understanding the market means understanding human behavior and, more importantly, your own. Markets swing between optimism and pessimism, greed and fear, because investors are human. The second-level thinker stays detached, watching this swing not as chaos but as opportunity. Let's take an example. During the tech boom of the late 1990s, everyone believed this time is different. Traditional valuation metrics no longer mattered, they said. Stocks with no earnings were soaring. The first-level thinker joined the excitement. The second-level thinker, however, recognized the unsustainable psychology behind the rally and saw risk where others saw reward. When the bubble burst, it was the few who practiced second-level thinking that survived and profited later. But this type of thinking isn't about always being contrarian or pessimistic. Marks warns against confusing being different with being right. Being different and being right, he says, that's the key. Many investors try to be contrarian for its own sake, assuming that going against the crowd automatically means genius. Marks disagrees. Being early can be the same as being wrong if you don't survive to see your prediction come true. So how do you train yourself to think on this second level? Marks recommends asking deeper questions. What is the market consensus? Why does it exist? Could it be wrong? What's the probability that I'm right instead? In essence, second-level thinking requires a probabilistic mindset. Seeing the market as a range of outcomes, not a single prediction. It's also about embracing uncertainty. Most investors crave certainty, looking for confident forecasts and clear narratives. Marks sees this as dangerous. The more certain people feel, the less risk they perceive, and that's when the greatest risk often exists. The best investors, according to Marks, live in the uncomfortable middle, confident enough to act, but humble enough to doubt. This humility is what prevents arrogance and complacency, two silent killers of investment success. As we explore second-level thinking deeper, think about your own reactions during market swings. When prices crash, do you see danger or opportunity? When everyone is euphoric, can you resist joining them? The challenge of second-level thinking is not intellectual, it's emotional. It's about discipline, skepticism, and patience. It's about thinking differently, not for the sake of rebellion, but for the sake of truth. To understand how second-level thinking plays out in real life, let's look at how Marks applied it in his own career at Oaktree Capital. When others avoided distressed debt companies on the verge of bankruptcy, Marks saw value. He realized that markets often overreact to bad news, pricing assets as if disaster were certain. But second-level thinking asked, is the market too pessimistic? What if the worst-case scenario doesn't happen? This contrarian insight became the foundation of Oaktree's success. It wasn't luck, it was a disciplined understanding that markets swing too far in both directions. In essence, Marks' success came from mastering second-order consequences. While others saw what was happening, he focused on what would happen next. For instance, when the market panics, asset prices fall. But eventually, that panic creates bargains. Second-level thinkers wait for that moment, not because they can predict exactly when, but because they know human behavior is predictable in its repetition. Every boom carries the seeds of its own bust, and every bust lays the foundation for the next boom. The average investor reacts to today's headlines, the second-level thinker anticipates tomorrow's psychology. This difference sounds subtle, but it defines long-term success. Let's take another example. When the Federal Reserve lowers interest rates, most investors see it as bullish, money is cheaper, stocks should rise. The first-level thinker buys. The second-level thinker asks, if everyone expects that, how much of it is already reflected in prices? What happens when rates go up again? What's the second-order effect on inflation, corporate profits, and investor sentiment? This deeper questioning separates speculation from insight. Mark's writings are filled with reminders that success in investing doesn't come from being smarter than others, it comes from being more disciplined, more aware of human nature, and more skeptical of easy answers. He emphasizes that you must develop what he calls a contrarian mindset with caution. That means thinking differently, but only when the evidence supports it. It's not enough to disagree, you must understand why the majority might be wrong and when their assumptions break down. The emotional challenge here is enormous. Being a second-level thinker often means standing alone. You may buy when everyone else is selling, which feels uncomfortable. You may hold cash when others are euphoric, which feels foolish. But that discomfort is often a signal that you're on the right path. Marx once wrote, in order to beat the market, you have to think differently and better. Notice the two parts, differently and better. Different alone isn't enough. It must be supported by reasoning, patience, and evidence. Second-level thinking also applies to risk management. Most investors see risk as volatility, the ups and downs of prices. Marx disagrees. True risk, he says, is the possibility of permanent loss. The second-level thinker asks not how much a stock might fluctuate, but how likely it is to recover if things go wrong. This perspective changes everything. It turns fear into analysis, and uncertainty into opportunity. It's why Marx and Oaktree were able to thrive in crises like 2008, while others were frozen by fear. They saw mispricing born of emotion. As we move through this idea, ask yourself, how often do you question the consensus? When markets fall, do you automatically assume danger, or do you look for hidden value? When everyone agrees on a narrative, do you pause to ask, what if they're wrong? That's the spirit of second-level thinking, curiosity in the face of certainty, and courage in the face of fear. Second-level thinking, as Howard Marks teaches, isn't a technique, it's a worldview. It's about approaching markets, risk, and human behavior with deep curiosity and structured doubt. It's about embracing complexity instead of fleeing from it. While the first-level thinker seeks simplicity, good company, bad company, the second-level thinker lives in the gray area, understanding that reality is rarely black and white. Let's explore what this means for long-term investors today. In an era where algorithms, social media, and 24-hour news amplify noise, the temptation to think fast and act impulsively has never been stronger. Everyone wants instant answers, instant returns, instant success. But second-level thinking requires slowing down. It's not about reaction, it's about reflection. Marx argues that true advantage in investing comes from insight, not information. Information is everywhere, insight is rare. Second-level thinkers take the same data everyone has, but interpret it differently. For example, when inflation rises, the headlines scream panic. The first-level thinker sells. The second-level thinker studies history, realizing that inflation cycles come and go, and that the market's emotional overreaction often creates value. Similarly, when growth stocks dominate, the crowd declares value investing dead. The second-level thinker sees cyclical behavior, that every trend eventually reverts, and that extremes never last. But beyond market insight, Marx's philosophy carries a moral dimension, intellectual humility. He insists that investors must always say, I don't know. This isn't weakness, it's strength. It acknowledges the limits of prediction and forces one to focus on probabilities, not certainties. It's a safeguard against overconfidence, the silent destroyer of wealth. Second-level thinkers build frameworks for uncertainty, preparing for multiple outcomes rather than betting on one. This flexibility is what allows them to survive downturns and compound over decades. Consider how this mindset applies to personal behavior. Most people crave validation, they want to be right now, to prove themselves quickly. But the second-level thinker is willing to be wrong temporarily to be right eventually. They understand that markets often punish patience before rewarding it. They endure ridicule, skepticism, and discomfort because they trust their process more than the crowd's approval. This is the essence of Mark's wisdom, that long-term success is built not just on intelligence, but on temperament. It's about controlling emotion when others can't. When panic spreads, second-level thinkers stay calm. When euphoria rises, they stay skeptical. They act not based on how they feel, but on how things are. As Marx often says, you can't predict, but you can prepare. That preparation, intellectual, emotional, and strategic, is the foundation of enduring success. In the end, second-level thinking is not about being a genius. It's about being thoughtful. It's about asking better questions, challenging easy narratives, and resisting the seductive comfort of consensus. As you finish this journey through Marx's philosophy, consider this: how often do you stop to question your own thinking? When you read a market forecast, do you ask who benefits from that narrative? When a stock crashes, do you see disaster or the seeds of opportunity? Second-level thinking is not a destination, but a discipline, a lifelong practice of seeing what others overlook. It's the art of thinking deeply in a shallow world. And as Howard Marks reminds us, that's where the real advantage lies. And that brings us to the end of our deep dive into Howard Marks' powerful concept of second-level thinking. If there's one lesson to take away, it's this: success in investing isn't about being smarter than everyone else, it's about thinking differently, questioning the obvious, and staying rational when emotions take over the market. The crowd will always react to the headlines, but the true investor looks beneath them, searching for truth, not noise. If you enjoyed this exploration and want to keep learning the timeless principles that guide the world's greatest investors, make sure to subscribe to the channel. Each week, we uncover the hidden logic behind the markets, the psychology that drives decisions, and the wisdom of legends like Howard Marks, Warren Buffett, and Charlie Munger. Don't forget to like this video if it made you think differently, and share your thoughts in the comments. Do you think second-level thinking can still give investors an edge in today's world of AI and algorithms? I'd love to hear your perspective. Thank you for watching, and remember, in investing and in life, the goal isn't to follow the crowd, but to understand it, and then think one level deeper.